In the last 6 months, the fund returned just under -0.5% versus a benchmark which is down 1%. Once you take into effect the Aussie dollar, which the Aussie dollar rallied over the last half, global markets were actually up. So the fund outperformed its benchmark and outperformed 80% of its peers as well. So we were quite happy with how we went over the first half. Firstly, just reflecting on where and what things occurred in the last 6 months, it was actually quite a difficult period to manage money in. Some of the investors may recall that back in January, February, markets fell quite heavily. At one stage, they were down over 10% in the US, and then they rallied very strongly back through February and March, and then they sold off again on Brexit. So it was quite difficult to actually figure out which way the market was going to go and to stay fully invested or to go to cash. So yeah, here we are. We sit here in early July, and markets are actually at a higher point. I think one of our most counter trend, or should we say contrarian views, is that markets actually keep going higher from here. We know that a lot of people don't believe this. A lot of our investors are quite skeptical about this, but we think there's enough things in place for markets to rally from here. So yeah, just walking through some of the stocks that added value in the last 6 months, the main contributor actually came from our short position in Woolworths. A lot of our readers and investors will know that we've had a very large position on the short Woolworths for some time. There's a number of blogs been written about our views on this. And during the last 6 months, they were forced to downgrade earnings twice again. As they have tried to fight competition against Aldi and Coles, they've had to reinvest in price. So the stock underperformed global markets and underperformed the All Ords. So that was our largest contributor. Our second largest contributor was a company called Open House, which is a Japanese condo developer based out of Tokyo. A lot of people think Japan is shrinking demographically, and that's correct. But what's interesting is Tokyo itself is actually still growing. So people continue to move from other areas of Japan into Tokyo, and Tokyo property prices have grown very strongly over the last couple of years based on net migration inside Japan and also free money essentially. As Japan's gone more into QE, people look for hard assets as they have around the world, and a lot of that money's come into property. So Tokyo property development's done very, very well, and we continue to stay invested in that stock. There's an old saying that markets climb a wall of worry. And in our half yearly that will come out accompanying this video, we walk through what's interesting is that normally a bull market ends with euphoria. It's very rare for a bull market to end in complete and abject pessimism. And what we see around us is fellow fund managers have some of the highest cash weightings they've had in almost 8 years. So they're back to levels of the GFC. You also see retail flows. So retail investors have pulled $150 billion out of US markets this year. So clearly there's not money going in, so retail investors are quite sceptical. You look at AAII, which is a survey data set, and that people are more bearish than they are bullish. So putting this all together, it would appear most people are very sceptical about markets. Now, if you look back to 2000, 2007, at those prior peaks, everyone was quite bullish and fully invested and flows were going in. It'd be a very rare thing, it's not to say it's not impossible, for markets to end with complete pessimism. So I think the backdrop's there. At the same time, like it or not, central banks are providing ample liquidity to the world. In a world where you get zero or negative returns on your bonds, a 3 to 4% yield on equities actually looks very, very attractive. So a lot of people talk about valuation being expensive. They are, but compare that to bonds and they actually look quite cheap. And so what you're seeing is money continue to actually climb a wall of worry. And where is some of that internal flows coming from? Share buybacks. So I said there's 150 billion of outflows in the first half. What's interesting is buybacks were 300 billion. So net, there was a net buy order in the US markets to the tune of about $150 billion in the first half. So you may not agree that buybacks add any value. You may say they're debt funded, but the reality is those buyers are still there.